Sure. All right. Thanks, Ash. Thanks for the intro.
Yeah.
I guess this actually talk is originally called "Get Your Mind Funded Strategic Investment." So it's probably the third year that we presented to the CFA Society. The first year we actually talked about getting your mind funded, and we'll talk a little bit about that and the recap. And I suppose this is the second talk in this series focused on strategic investment, which is basically the focus of what we're going to talk about today. So really, our first presentation in 2023 was just about focusing on the learnings and some of the key metrics from some of the successful mine funding processes that we'd observed. So what we did was we put together a data set of successful mine funding processes and used that to understand what the characteristics were. So today, what we're going to speak about is just one of the pathways to getting a mine funded, bringing a strategic investor on board as part of the whole mine development process. So what we're going to do today is just cover off, firstly, just recap some of the findings of the 2023 presentation. We're going to discuss, I would say, a theoretical funding story of a mining project and how projects may get stuck. We started by using an actual project, but that was a bad idea in Perth. So we'll stop right there. It's not a good... No. And then we're going to talk about some common characteristics for our mine fundings where you involve strategics and strategic investors. And then finally, we're just going to go through and look at a few case studies and see how we are for time. And so just to recap, and Pat, throw in any comments you have as we go along. So for those of you guys who did see our presentation in 2023, and I think it was a webinar at a time, our presentation really focused on what the learnings that we could get from some of the fully funded mine projects that we could observe over a period of time. And so we collected up data from 2018 to 2023 and looked at some of the common characteristics and what we could learn from it. So what we did was we looked at some of the success metrics across all these different projects and studies, and looked at what are the rough numbers that resulted. So a few of the learnings were specifically the first was we observed a lot of projects were funded in the gold space was funded mostly traditionally using traditional finance, and then you'd have a suite of other projects, other commodities that were financed with a range of non-traditional and government sources of funding, and as well as equity only. So we looked at sort of funding sources and how they got funded. Then we looked at some of the success metrics, and on the right-hand side up there, you can see that there's a whole heap of different metrics we looked at, from size of capex, from capex to pre-tax NPV that was published, from payback period, from steady state NPV to capex, debt to funding ratios, capex to market cap, the equity raise component when they raised equity to the market cap at the time, and then the equity raise discount. So what we were trying to do is just see, okay, what are the common characteristics? So what do they look like? And there weren't a huge set. There wasn't a huge set of data. So you couldn't necessarily say it was statistically significant, but I guess it gives a bit of a guide for how projects get financed.
Is there one more important than the other in those?
I think we all have our favorites. But for me, the key one, and I guess kind of segues into the strategic investor piece, is probably the equity raise to market cap requirements. Because and the other thing is probably the capex. You don't see billion-dollar projects on this metric. You see, max is 300 million. So it just shows you how hard those much larger projects, I'd say, actually fund.
Yeah. And then you're just saying the gold traditional project finance, and then lithium, I think, more strategic equity. Anything different this year so far? Is there any shifts there?
So when we did this, I guess you see mineral sands and potash sort of flash up there. They're probably due to, I guess, the government financing piece sort of supporting those projects. And I guess for my sins, I used to be at Naust, so I actually worked on most of these. But if you roll forward, say, another 5 years, you'll find that those mineral sands and potash is gone. Lithium is probably a bit more mainstream these days, commercial backs. But the first one that was funded project finance wise was actually done via Nordic bond, and it was done via Nordic bond when interest rates were much lower. So if you try and fund something like lithium or something else with Nordic bond these days, you're probably looking at 15% plus in terms of your cost of debt.
Cost of debt. Yeah.
And that makes it very hard to actually, makes it very hard to actually sort of cover that through your project.
So I suppose on that note, I guess some of the key takeaways that we came out with after going through that 2023 presentation, obviously funding resource projects, you've got debt, equity, and then a number of other sources, including government grants, government funding, such as Patrick spoke about, NAIF and so on. From an equity perspective, you've got various structures like joint ventures, offtake agreements with equity components, and so on. So there were lots of different pathways to the funding for a mining project. So one of the things that I guess going through this, we looked at some of all those different factors, and we came out with sort of four main things to really focus on, and that was really the size of capex. And you can see on this slide that we've got sort of target and threshold. Obviously, capex since 2018 to 2023 has probably jumped substantially, right, since that time. And so, you've almost had to rebase some of this now. But at the time, we could see that a lot of the projects were funded with, roughly, I think it was a mean of about 171 million. So, you want to keep capex as low as possible to make it fundable. Obviously, the characteristics of having a short payback period reflects the economics of the project. Debt to funding ratio we saw was about 58%, and that was sort of in line with the sort of golden 60-40 ratio that we typically think of. And then more importantly, as Patrick alluded to, the equity raise to market cap to actually get that capex funded was about sort of 32%. So that's kind of where we want to end up. So talking about all this, I think we ended up with saying, okay, well, there's if you're outside of these sort of metrics, it's probably a little bit more difficult. And things like commodities, outside typical commodities like gold, where you can hedge, you probably need a combination of different things, including strategic investment, government support, and other non-traditional finance approaches. So that's one of the reasons why today we decided, okay, we're going to focus on strategic investment, because I think it's pretty critical to support equity raises. And when your capex gets too high, you end up having to go via an alternate route to actually get your mine funded. So what we've put up there is just a bit of a theoretical funding story. If for those of you guys who haven't been around mining, this is a Lassonde curve, right? And how would you describe it, Pat? A model of what mining projects go through as they go through a cycle through to construction and actual operations.
Yeah, well, I think it tries to show a more practical path for mining company share prices from that exploration stage through to development. Because I guess without having seen it's in action, you'd be, if given to thinking that, if you make a discovery and then you continue to de-risk it through feasibility studies, your share price should just keep going up and up. All things being equal, but commodity prices, etc. But that's certainly not the way it plays out. And I guess you typically see it playing out like this. It doesn't look exactly like this, but after that initial discovery, a lot of speculative sort of money comes out of the stock. And then you find the share price either tracks sideways or it dips down. But what that means is that when you finish your feasibility studies and you look to raise, your market cap isn't high enough to be able to raise the equity that you need to develop your project. So that's probably the most relevant thing in this theoretical funding story. And I think we've got an example after this with some actual numbers there, which makes it.
Yeah, have you got a project example that you can refer to?
Yeah, it's on the next slide. Yeah.
Yeah. Well, I think this project example talks more about a theoretical project how projects get stuck, right?
So just quickly, and so that's that orphan stage. If you could just talk to the dynamics of that. What do you mean by that orphan stage? What is its characteristics?
Yeah, so I think theoretically, you'd imagine that on a theoretical basis, as you de-risk a project, as you do more and more studies and you firm up capex, your actual value should increase, right? Especially if your economics is okay.
Yeah.
But in reality, I mean, you're subject to lots of vagaries in the market. It's commodity prices are a big thing that shifts things around. If you're unable, if the capex is too high and the market doesn't believe you can fund it, you could also get stuck as well. There's a couple other points sort of in this slide, uncertain market demand. If you don't have some form of firm certainty on getting your product sold, like inappropriate partners that come along for the ride that, where the market doesn't believe they can actually support you through to get your funding. And management as well. There's if you don't have the right management to get you through to production, that's an issue as well. So one of those examples is up on this slide where we look at a typical funding story. You announce a discovery, you do your preliminary feasibility study or PFS, you get your DFS completed. There's lots of excitement about the stock and about the project, and then something in the market goes haywire, or people stop believing in the story, and then things start tanking. And so in this example, you've got a DFS announcement, and then your market cap starts to slide. And where you end up is, when you announce your DFS, you said that you needed 500 mil in this example of development capex, and a total funding package would be, 500 plus your working capital plus cost overrun, call it 600, right? By the time you're done, how do you fund it? Well, you need, even just using a 60-40 debt equity ratio, you need equity of about 240 mil, and you've got a market cap of 50 mil, and you need to raise 4 times over your market cap. No, it's just not going to happen, right? The market's not going to believe that story. Yeah. So I guess that's one of the reasons why some projects get stuck. And you look at juniors and they just get stuck in no man's land because they've got really no way forward. Market doesn't believe you to go further, and you can't really. Well, you're also burning cash because you're paying your management.
Just to go back to Ash's question, maybe flip back on the previous slide, just around the orphan period, I guess, that second last bullet point has probably got a few factors in there. So the reason why you end up in that orphan period is because you've got that exit of speculative retail investors. You get a lack of stable insto investors at that development stage. Lack of share price supportive announcements. So as you're ramping up, you've got all this exciting news about, we've done a drill and it's come out, 20 grams per ton, sort of over 20 meters or whatever. You get all that exciting news, but once you get into that sort of into that feasibility study, like all you're doing is saying, this is what we're going to do to develop it. This is what it's going to cost. That news flow isn't as exciting.
Yeah. Okay.
Yeah. So that's how I see that orphan period just kind of just drags on. And plus you also need a bit of time to do those feasibility studies. Like typically it's 9 to 12 months for a PFS, if that again for the DFS.
Yeah.
You just end up this period of time where you don't really have that exciting news flow.
Is there any sort of early warning signals that you're not going to be able to tap equity post that DFS? I mean, is there some signals that indicate, even though you're in there, that you're not going to get out of there? Is there anything that, or is it you discover it as you're in there? And
it's probably the share price, right?
Yeah.
So yes, to me the earliest warning sign is probably PFS when you actually release that.
Okay.
And if the share price doesn't move, that doesn't mean that as you're doing the DFS from PFS, your commodity might become hot again. Whereas you're setting gold or something else, your commodity might go hot. That sentiment kind of drives up.
The sentiment drives it.
Yeah, or you bring in a strategic or something.
Yeah,
and that kind of drags it up. But the earliest warning sign would be probably after you've done your PFS, in my view. What do you think?
Yeah, I mean, look, with the market's acceptance of those results really tells you, in what direction sometimes it's going to go, right?
Yeah.
So just going through to some of the work that we've done to look at strategic investment. I guess just going back to being stuck. What we wanted to do is to see, okay, well, what are the solutions out of that sort of orphan period, right? And one of the key ways is strategic investment, to get a strategic investor on board who have interest aligned and can help you through along the way. And so what do we do? Well, we looked at about 11 projects where a strategic investment had occurred or will occur. Um, and so we looked at overall 11, but six ones in detail that had been funded and constructed to date. And so what are the common characteristics when we looked at these? Well, the first was that so interestingly, almost all of the strategic investments in this list sort of occurred post PFS or preliminary feasibility study, and actually most of them occurred after the DFS was done, or the definitive feasibility study, which was sort of surprising but not at the same time. I guess it just means that you really have to get the project to a certain point of certainty before a lot of strategics will step in.
So just to also just to explain that preliminary feasibility study at DFS, what DFS means. That's just yes, in layman's terms, it's a level of certainty on your on your costs, on capex, on those to actually develop your project. I think DFS is generally plus or minus 10-15%. I think PFS is meant to be plus or minus 20-30%.
So, Patrick, just something when you say, maybe for everyone in the room, cross that in, when you say 10-15% in terms of...
Yeah, just cost estimates. So
your
capex estimates, your opex estimates. So certainly, if you do more work as you get to that DFS stage, you'll get firmer contracts and quotes and things like that.
Yeah, okay. So it's either side of a midpoint range, you're saying. It's somewhere in there.
Theoretically either side, but usually the
It's usually a C minus D.
Nothing comes down.
It's not quite. Yeah, it's not quite minus 15 and plus 15. It's probably more like plus 20.
So,
but sorry.
Yeah, no, that's fine. I think the other thing that we kind of put together was we looked at the investor size, the size of the strategic investors that came in, and no surprises that a lot of them were quite large. Developers brought in groups that had pretty big balance sheets that could support them.
Through all of that, with your experience there, what surprised you the most out of those? Is there any particular outcomes that you weren't expecting, or?
Yeah, well, probably. I think we mentioned that it's probably just the timing of when we get them on board. We actually thought would have more of them sort of earlier on in the piece, like post PFS or even advanced through the pre DFS. But actually, it looked like you really have to get it.
So they're quite clear where they'll get involved in the risk curve in a sense.
Yeah, I think so. But and not to say that you can't get them involved earlier on, and that's what we'll sort of talk about, because I think some of the prospective cases that we were looking at actually had them involved a bit earlier on. But typically, most of the ones that we looked at, it was probably DFS, advanced PFS, DFS. Oh, I'm sure they're always talking, right? Like but to actually get some certainty around something going ahead.
Or they just wait for the share price to go low enough.
That's right. Just wait until after the DFS and things tank.
You announce the movement share bucks. Yeah, that's been there. It says the actual strategic investment, and are they is it for investors in actual projects itself or the company?
That's
great question.
Christian. Because we'll get to that in the next slide. But look, a combination of both. But probably more on the project side. But we'll talk a bit about the structure. So just to cover off this particular slide, I guess the other thing that we observed is you look at the capex of these 11 cases, and actually the capex was quite substantial, right? I mean, you've got a mean there of about 568 million. The other metrics, payback period, etc., are kind of in line with the metrics that we sort of looked at for a wider set of funded projects. but you also see that the equity requirement post the involvement of the strategic sort of brings down the requirement to a level that sits within our what we call our golden rules, right? So basically, the involvement of the strategic managed to get the project funded to a level where it's achievable. I think is really the moral of that story. So just going on to this next part. Sorry, maybe we'll get to your question in a bit, because there's a couple of other slides. I realized that before we get to it. Well, this slide here really talks about what the market cap was, as well as the for the investee and the capex. So just looking at from left to right, you can see there's a set of six, I think, six projects that were fully funded with the strategic, and then the ones on the right were the ones that have had announced, I guess, strategic investors involved. And so on the left, what we're really talking about is, you look at the amount of capex compared to the market cap, and in general, the investor or investees sort of market caps were substantially lower than the funding required for the capex. I don't know, anything else to just sort of cover off here, Pat?
Oh yeah, so just in those in progress project dots, right? I guess the expectation, they're still in progress. So when you get close to FID and they've done the DFS, you'd expect that those strategics would actually make additional contributions. So that should actually push your strategic investment up. So all those dots you'd expect to move up.
Yeah. So
or the orange ones anyway.
That's right. So on the right hand side, you see really the strategic investment provided versus the amount of capex, and you see, the strategics came in for a decent proportion of the capex that was announced. As Pat said, the ones which are still in progress, they're still the strategic investment is still fairly low, but that will have to rise substantially as they go through and firm up the actual JV arrangements and so on. So this slide really talks about, for each of these 11 projects, what stages strategic investment occurred at. And you can kind of see, from left to right, you can see the stages of the project, going from exploration to PFS, DFS, to reach the final investment decision, or FID, reaching practical completion, and then project completion. You can see how they progressed over time. And this is what we sort of mean by the fact that a lot of the actual projects, or a lot of these companies or groups had funding occurring after the PFS stage, and more likely after DFS, right? But you can see that, in terms of the ones that are in progress, a number of them are actually having discussions at the PFS stage. So it's actually more common at the moment, as compared to some of these other projects that were funded in the past.
Is there a capex market cap sort of multiplier where you just can't have the conversation? You just can't progress 4 times, 5 times, is it?
Historically, you've seen 1 times market cap raise being achieved. I think it's probably easier maybe in some of the gold projects. But yeah, 1 times you can, but even then that's pretty dilutive, right? Yeah, existing shareholders. Yes, based on the analysis, it shows that, a third to maybe 50% of your market cap is a raise is probably more cheap. Okay. But the beauty of, I guess, the strategic investors, and I'll just go through in a bit, if when they invest, they might buy a piece of the project, and when they buy a piece of the project, you actually get cash for that.
Yep.
Which means that now you've got a chunk of cash, and then because you've actually sold a piece of your project off, you need to fund less of the project equity. But you've already got a piece of cash which you can actually use as equity as well. So it actually works like that. So which means that if you do need to go and do a raise, the raise is more cheap.
More cheap.
Yeah.
Yeah, and so just on the theme of what strategic investors add in terms of value, I guess we looked at what are the key things that they brought to the table, And for the ones that achieved, they had to finalize their funding structure. Basically, a lot of the strategics really helped get the full funding solution in place. They also, a lot of them provided offtakes as well, which provide certainty of revenue and sometimes pricing. All of them in this list were what would consider to be credit-worthy investors. And then in terms
Does
of
that become a critical threshold then in terms of the partner? Is it above all else?
It's also relative, right? Relative to these. If you're going to the juniors companies,
Yeah, okay.
but I mean, in general, in balance sheets that can actually help support the project in some way.
What a ticks there in.
Yes, yes, no, absolutely. But we'll talk a bit more about that, and then I guess the other thing is some of the strategic investors brought in technical and operational expertise as well. You can see in the fully funded set, only one of them really openly or announced providing that sort of expertise. But I mean, and it's more likely that their involvement would have provided some form of expertise in some way.
Okay.
Um,
It's all nice to have, but that credit word,
it's probably out of those four, I'd say the full funding solution is probably key. Otherwise, the project just doesn't get up.
Yep.
And those other aspects are probably more to facilitate that funding solution.
because they feed into more.
Yeah, the other thing that we put together, and look, this is a little bit complicated to explain, but I guess what we looked at was really the developer, the equity requirement versus market cap. So we looked at these ratios, the equity requirement for the project from the developer versus their market cap at the time, before the initial investment of the strategic, and then at FID. And basically what we could see is before and after, you're basically bringing down the ratio of equity to your market cap. For these 6 sort of fully funded projects, you could see that ratio going down to something where it was, practically able to be funded. And the only thing we sort of point out there is that it's actually the metrics actually would appear better than what they've appeared in this chart. So because for example, the example of Gold Road, that was actually they got a consideration which was paid for their project, which they then just put into the project, right? And that hasn't really been counted there in that slide. The other thing that we noticed is that actually the time required from first investment to FID was actually really quite low on the most part, and that was because really the strategics came on board pretty much at that FID announcement or just slightly before. And so basically it's all packaged into that FID announcement, which we actually kind of didn't expect, but it just happened that that's actually what the data said. I don't know if there's anything else.
Yeah, I would say BCI is a bit of an outlier just because ACE were involved so early. And I mean, they will be a major shareholder right from the start, and all they did was just increase their percentage as they went along.
Yeah, that's right. So I mean, because they were a very, very long-term strategic investor there, but we'll talk about that specifically a bit in another slide. So just back to your point, I think the investment into the strategic investors generally invested both at the corporate or the project level, or both the corporate and the project levels. And so of the 11 we looked at, I mean, there were about at the project or combination of project and corporate level or company level, we had about 2 which were minorities, 3 which were 50-50s, and 2 which were actually majorities. And so that's interestingly, I mean, you obviously expect that the strategic would take a substantial share of ownership in the project in some way. And as we said before, in terms of the 6, you could see all the 6 fully funded solutions. The six case studies where they were fully funded. The strategic investors brought in the ability to actually get that funding closed. So we've sort of spoken a little bit about each of the key factors there. So overall, what works and what doesn't? Well, I guess we've spoken a bit about this a little bit, but really what works there that we can see is that you really need an investor that a strategic investor that can support a full funding solution, who can provide the necessary equity and debt and has the appetite to do that, right? And what doesn't work is pretty much the opposite. Choosing a partner that may not have the appetite to provide a full funding solution, or who may actually limit the involvement of other investors who can actually get you there, right? The second one is really investors that provide offtake arrangements, and that's pretty critical for non-exchange rate traded commodities that require a lot of the pricing and revenue support. What doesn't work is, and you can observe this a little bit and we won't name any names, but where you get an offtake, they announce that they get an offtake with a party, but it doesn't come with enough funding for the project development to actually fully close that project development requirement. And then that's one way you can sort of get stuck as well. I don't know if you want to add anything.
Yeah, I think that's probably the worst possible scenario. So it's one thing where you actually have a sort of a announced and agreed transaction where you've got a strategic actually investing in and taking offtake as well. But the last thing you want is where the offtake is actually one of the most valuable sort of bargaining chips that a company has and a project has. If you actually give that away and then the strategic actually pulls out or isn't able to provide that additional funding, you're stuck, right? Because you no longer have that offtake to be able to offer up to another strategic investor.
Oh, no, but I mean, we're talking about when they do come in and when they're prepared to come in. Is there any pitfalls to bringing them into? Is there any constraints there?
Well, probably that offtake one where you give up all your offtake at the stage you start, then you're stuck.
And also, if you bring him in early and they invest at a project level, the value of your project is probably not as high early on, because most strategic investors will probably discount it pretty heavily because you haven't actually done the work to really firm it up. So that's the other issue. And then if you're not getting enough for, say, a partial sell down projects, it just makes it harder for you to fund the rest of whatever you keep.
Okay, with all that in mind, do you have to structure exit points as well then for these? You bring them in, you want them in, and that's
it depends on who you are, right?
Yes,
yeah, it depends who you are. I mean, ideally, if you're the company trying to attract a strategic investor, you're generally going to be more of a price taker, I guess. So you might not want the milestones, you might not want the exit points, but you might not have a choice. But I think what's more important is if there is exits, you need to make sure you're left in a position where you can still actually find another strategic investor, still got all your chips. So offtake again is a key thing.
Key thing, yeah. Okay. Any questions along the way there?
You guys can call bullshit.
So, and just closing out this sort of discussion, I guess that we've spoken about creditworthy investors. Really, you want someone that has a balance sheet that can provide comfort to financiers and provide support for, more importantly, cost overruns and support the project through the completion of construction, and then through into operations as well. And where you have investors that don't really have a sufficient balance sheet or appetite to really follow through on their investment, that's where you can get stuck as well. And then finally, technical and operational expertise. Yeah, it's probably not as critical as the other points, but really it's helpful sometimes to have a strategic investor that can help provide that as well. So I guess moving on to some of the case studies so you can actually look at some of this in practice.
So the first one is Sheffield, and in my mind, this is kind of the benchmark of if you were going to do a strategic investment, what sort of deal would you want? This is the one which you'd want. So this is the pre-Yansteel, so pre-strategic investment sort of part of the story. So they've basically ticked along. They've done all the things that you would typically do. They've actually done the DFS. They've gone and raised, secured the debts, subject to the equity piece. And so equity is usually a condition precedent to actually unlocking the debts and actually achieving FID. So they've gone long. They've got the 300 million mandate Taurus, which is this a resources sort of investment funds. They've got the 95 million from Nath, and that's completed that debt piece. But of course, they still had to raise the equity, and typically the equity is 40%. Again, that 60-40 magic number. So based on the capex of circa 463 million, and that's just capex. That doesn't include your working capital, your cost overrun, etc. So there's always plus plus. So the actual true sort of project funding requirement would have been over $500 million. So it would have been 500, 550. And typically what you see is like as soon as they've actually got the debt locked in, they will very quickly move to actually raise equity. You don't see this in the public announcements, but they actually tried and they fell short because at the time their market cap was, call it 250, 270, and they had to raise over 200 million. So they would have had to raise pretty close to 1 times their market cap, and they fell short. And because they fell short, and that also coincided with a dip in the general market, you see their share price, which is there, it just goes down like this. And then over this period of time, they've reworked their BFS to try and bring down the capex. But yeah, it was just you get down to this level. They brought it down to 390, but you still need to do the plus, so you're still looking at over 400 million. At that point, their market cap is under 100. So at that point, 40% of that, you're still looking at a bit under 200 million. So no chance. And then at some point here, I think they kicked off a strategic investor process where they got a number of investment banks to try and help them find someone who could actually come and help them with their equity. And then come along, then you get Yansteel. So this is the tail end here of that period. And then they announced that Yansteel JV. So Yansteel's come in here with an investment at both the Sheffield level, but this is probably the key bit here where you look at. So their market cap here was around 150. They announced a JV there where they've sold half the project for 130 million. So close to their market cap. And that money has gone straight into the project level and has effectively solved for most of their equity. And plus, Sheffield at that point only needs to fund their 50% of any additional equity.
Did you have any specific negotiation?
Yeah, look, I think it's just looking for those win-win opportunities. I guess Yansteel, traditionally in iron ore and steel, wanted to get into mineral sands, saw this as an opportunity, and they also just go to that technical ops expertise. They're not the operator; they weren't involved in the construction, but they certainly had a lot of input into if you produce this sort of product, we can actually take it and process it in China. So there was that sort of technical input there, and it was a bit of a win-win. So, and Yansteel saw that because a lot of investors, especially financial investors, they'll look at the market cap and say, why do I pay you 130 for half when I can get the whole thing for 150, right? So that's a pretty common way of looking at things from financial investors. But certainly Yansteel had, a broader view, a longer term view, and mineral sands projects go on for decades. So they certainly saw the value of that. Yeah. And if you look at we did have the MPV here, but the MPV is certainly pretty robust. So what I find in a lot of these successful cases is they actually look at the project MPV sort of metrics rather than just looking at, okay, this is what the share price is, this is what the market cap is. Because there's also value which Sheffield brings is that their local partner, they have the technical expertise, they know the deposit. Yes, you might be able to take out Sheffield for 150 plus the takeover premium, but you might lose that expertise. Yeah. So there's those sort of, I guess, intangible qualitative aspects you need to consider as well.
The JBL.
Yeah. So like I said, this to me is like one of the kind of benchmark sort of poster child of strategic investments. And then once they had, I guess, effectively the equity secured, they went through the debt process all over again. It's part of that they had to retweak. They had to tweak
the ratio is there. Then
the ratio is the same, 60-40. The capex was thereabouts. It's like 400, 500. Once you take into account escalation and cost overrun, etc. And then achieved FID there, first production there. So here, looking at it on the bottom, that's complete. They were able to come up with a full funding solution, provide offtake for some of the products, the immunites, not the zircon, creditworthy investor. So followed there, they're able to sort of provide that cost overrun support if they needed to. Technical and ops expertise, we don't have that highlighted, but there's very much a component of that in there in terms of working up the revised sort of feasibility. Any questions there? And then, this is just the source and uses here. As you can see, you've got Orion, which is another one of these resource funds. NAIF did a revised sort of loan for this project as well. They previously approved something. And then you had Yansteel, that 111 came from the initial 130 investment. And then the remainder was split in a sort of, I think where Sheffield had to fund the first 10, and then everything after that you split.
the residuals in there, no lump sums in it at all.
Well, the 130 was a lump sum straight into the project level. That didn't go to the company. That didn't go to Sheffield. That went straight to the project. And then the rest of it was just split when they had to draw down. But as you can see, Sheffield's gone from needing 200 million equity contribution to needing 34. They sold off a few projects, and they will just have to fund it from the process of those projects. So this is how you get a project funded if you're stuck.
You're orphan.
Yeah. And this is uses there. You can see capex, contingency, cost overrun, and then you've got the usual work capital during ramp up.
Half that runs to given. That's
So how it is. Yes, it is. So how I typically explain it. So contingency is usually it's contingency for the sponsors for equity. Cost overrun is effectively the lender's contingency. So you might have cost overrun for 10-15%, which is for equity. But the lenders are a cautious bunch, so they are also asked for additional contingency on top of the sponsors.
So all your funding agreements, that's identified separately in there for that.
It's contingent, and usually how it works is that it's a contingent facility. If you need it, you draw it. They usually do the gearing with that included up front. So you add it all in, and then if you do have to draw it down, it's the first money which gets paid back for a sweep.
Yep.
I settle.
Accurate.
In theory, they should be coming up separately, but usually it comes from the
closer.
Usually, all the financiers will have their kind of shortcuts, I guess. In theory, they should actually get it from the independent technical expert who they employ, and if the independent technical expert says, I think there should be 5% or 10%, that's what they should go on. But usually the technical experts will also have their shortcuts and also are conservative. So they'll generally say it's 15% or it's 10%.
There's always been there is race. It's there for a lack.
Oh yeah, absolutely. So, well, there's good reason for that, because most of the projects that are being funded, even though the cost overrun facility is contingent, it's not meant to be drawn. Every project I've been involved in the last certainly 5 years has had drawn that fully. Yeah. So yeah, it does get drawn. Yeah. Especially, I mean, in fairness, also in this last 5 or so years, you've had rampant inflationary pressures as well. So that certainly doesn't help. But in more
supply chain.
yeah. So in a more stable environment, that contingency might be a bit lower or it might not be touched. But certainly in the last 5 years, you see inflation eats into that a lot. But you can negotiate. You can try and negotiate away, but most financiers generally.
Jump on to the next case.
Yeah, of course. How are we going for time?
Now we
Yeah.
jump on to the next one. Yeah, that's all. And also interesting.
Yeah. So this is BCI and ACE. So this is one where supportive investor. They haven't actually invested at the project level. They're at the company level, but they've jumped up from 20% to 40%, and they've just supported all the way through. This is one where I led the approval of when I was at NAIF. Big chunk of loan, 490 million. And this is one where NAIF went first just to provide that confidence to commercial lenders and other lenders and the market generally to show that, yes, you can get this funded.
Yep.
This is a very big thing, but 780 capex there, but I think it's actually higher than that. So I think it's probably well over the fill in.
But you've got FID. So what happened? It's picked up there. After again?
I think sometimes FID can be called, whenever. The general market convention is you generally call it once you've got certainly at least the debt secured, subject to the equity, and you probably need, as a director, you need very high level certainty that you can get the equity away as well.
So is this any good? Because I know it's picked up, then you come right off again. Is it the market cap?
Yeah, I think sometimes it's just it could be the general market. It could be lack of news flow. It could be them expecting cost overruns. Who knows? We haven't actually looked to that. But this is an example of just that long-term support. Now, the point I did want to make is when I was at NAIF, I guess, if you're looking at a 70 million market cap company looking to develop $1 billion project, if you didn't have someone like ACE as a shareholder who could actually support that development equity raising, you wouldn't even pick up a pen as a debt financier, just because you don't have that confidence that if you get through and actually prove the debt, the equity will be there at the end. So you do need to have. That's where someone like ACE or even Hancock has that ability to actually provide that comfort that you do all the work on the debt, at the end the equity be supported. So you've got that equity strategy there, which actually is believable.
Any challenges with the government private equity sort of space there? Is it NAIF?
Look, no, I don't think so. I mean, early days you had this whole thing where government financing wasn't that well understood. But NAIF has paired up with commercial banks, private equity, Nordic bonds, other government financiers, grants. So there's not really an issue. Offtakes, you can make it work. So there's no real issues. Especially when government financing is meant to be patient, it can be structurally subordinated. It can help support. It kind of gives the other lender, the private sector lender, ability to be repaid first. So once you actually go into the details, it's actually most of the other co-financiers don't really have an issue with that. Or other government financiers. So this is the sources and uses. Again, you see this cost overrun facility there. Again, it's contingent, but you include it in the stack anyway. another thing to note is just you'll see a common theme in the uses here. There's always the capex, which all the companies announce, but they usually never announce the pre-production ramp-up costs, working capital, and the finance costs, and they don't announce the cost overrun. Yeah. So as you can see,
And they're not as quiet to do that, is it? I mean,
I don't think they are. But as you can see, you go from 841. When you go plus, you get to 1.3. Yeah, no, that's a good question. So when we were looking at it, they still had some residual iron ore assets, which I think they had an agreement. Well, they effectively sort of farmed out to Minres, so they were getting almost like a royalty payment from Mineral Resources on those assets. So there was a little bit of a support there in terms of that those funds coming in from the other project, but they were fairly small relative to this. So you kind of looked at it, you do get some benefit, but it's not like you've got a nice sort of spread of producing assets and producing cash flow streams. You do get some benefit, but not a lot. Right. Yeah. Core Lithium. So this is probably every managing director's dream, not having to deal with bankers. So this is one where they funded their development purely from equity at pretty much the height of the lithium boom. And they didn't have to go debt at all. And Ganfeng, it's basic cornerstone, their equity raise also took offtake as well. Yeah. Now, of course, this is now in care and maintenance, but in terms of getting it up to production and using cash, it's not a bad story.
Not very common though, because you've got to have the timing right in the right cycle at the right time.
You see in gold, right? I mean, this it helps that the capex is actually pretty modest here as well. I mean, if you're looking at a project which is like sub 100 mil, capex, it's generally pretty achievable.
why not this? Why not do it?
I know that's probably a question for management. I mean, you might not go debt because I guess going down debt, there is that due diligence requirement. It does take time. You do have to cross the T's, dot the I's. Most management teams, especially if they're not used to actually dealing with debts, they prefer just to get it from equity, and they can just, they don't really have that same, requirement to have to, report back to debt holders and things like that. They just run it the way they run it. So I imagine that's why you don't. I mean, in theory, if you're not leveraging it and you're not using cheaper debt, then you're not maximizing your return. But then it probably just comes down to a control and timing issue, I guess.
Yeah, it's a lot of work.
Yeah,
it gets
to work.
It's a lot of work.
Yeah, and I guess you remember this is Core was actually one of the earlier lithium plays as well. So options in terms of debt financing for lithium projects, there weren't that many. So I mean, Pilbara was probably around the same time they went down Nordic bonds.
Yep.
But yeah, I think it was maybe after this that some of the commercial banks started to actually fund lithium.
Yeah, so just availability of it.
Yeah, it's tight. Yeah. So yeah, there you go. Nice, easy source and uses.
In spend.
As you see, you still got the working capital implied, but there's no cost overrun. Debt.
Conscious of time, you want to certificate that's debt. Yeah, no, just highlight there what there is. If anyone spots and recognizes one they want to have a chat about, Patrick, that's you afterwards about that.
Yeah, I'll just run through this. So Gold Road, Goldfields, this is one where it's a big project. This is the one where you've got the technical ops expertise. Goldfields actually took over as effectively the operator for the build and ongoing operations. Again, this is no debts. The Gold Roads piece was actually funded from what they received from Goldfields for their share, the share of the project they sold.
Sorry, I'm going to jump in there. Why have they asked that it wasn't fairly? Isn't probably a contingency there. I see that.
Good question.
Yeah, I think it probably came from one of the announcements. I suspect that we probably picked up in that IT. But I think it was just it effectively in addition to the contingency, I suppose, or this continue.
Yeah, I haven't seen that before, to tell you the truth. Yeah. Usually they're not that open in terms of, I suppose. You just
probably hide it.
you just hide it somewhere, right? Yeah.
Sorry.
No problem at all. So yeah, so that one was that reason. Liontown, this is a complete one. This is a rare one where you didn't have what we considered the strategics being Ford and LG taking a direct interest in the project. Ford provided a loan in return for offtake. LG provided a con notes, which could become equity, but also in return for offtake. So this is a very interesting, and there's a whole bunch of stuff here, which it's quite an interesting story if you try and follow the funding path of Liontown, including the failed takeover by Albemarle, and I guess Hancock's sort of involvement in this. Okay.
There's never a straight any relation to plant going up. Which chart has got this?
No.
So
Yeah. Or as we've overlaid the spodumene price there, so this is kind of the fortunes have kind of gone up and down with the lithium price.
Pretty much every single case study, right? You look at the price against it.
So that's on. This one here is still also a very good example. So Toyo Zinc actually came in at the project level, and because of their investment, Galena didn't have to do equity raise in this one. So this is again not it had debt in there from Taurus, but Galena didn't have to do equity raise. So again, this is Arafura. So this one is in progress, but certainly, so Hancock hasn't actually provided any additional investment or basically cleared the equity that they require to actually hit, I guess, full funding.
Yep.
But certainly their involvement, it suspects, actually helps with getting the debt from the government, so that US 533 from Nathan EFA, and also that that con note investment from another government's agency, National Reconstruction Fund of 200. But this one's still incomplete. But yeah, having Hancock there, similar to ACE, gives you that confidence, gives debt financiers confidence. Idea, this is a good one. So this is, I think Gav mentioned this before. This is one of the ones where they have invested earlier. So they haven't just waited until after DFS. They've actually come in earlier. They've actually come in and provided some funding to complete those feasibility studies. Also at the project level, but I think later on they also came in at the listed co as well. And that's a big project. It's like a $3 billion project. Taiwan and Sumitomo, similar. Like fluoride is, I'd never heard of fluoride until these guys actually, announced it. Like, what is that? What do you use it for? It's so niche. But Sumitomo were able to come in, JV, also secure the offtake. Not sure whether they'll do debt on this one, just because it's so niche. But certainly with Sumitomo's balance sheet, I think they are starting discussions on closing out the rest of the equity funding.
Yeah, no, Taiwan's done a good job. And they're our clients, so they've really done a good job of getting that project and getting that JV in place with Sumitomo, because it is a very niche commodity.
Yeah. Also, one of the earlier stage investments. So the common theme here seems to be Japanese Sumitomo.
Yeah, I think they probably take a longer term view in a lot of these sort of opportunities or projects.
Yeah. And this is hot off the press. This has a pathway. This is one of those ones where they've done their DFS a little while ago. Share price has drifted, and then Mineral Development Partners has come in with basically a structure which actually gives them the pathway to full funding. Yeah. In the way of everyone and their drinks. So
takeaways.
Yeah. So Hastings and Wailu. This is also hot off the press. Walu hasn't really put in any hard cash yet. I think they've kind of given some debt and all that sort of restructure, but they've taken a 60% stake, it's the majority stake, isn't it, in the project? So, but this one will be an interesting one to watch as it goes forward. Conclusions and findings. So yeah, point one, strategic investments generally driven by funding, offtake, and or technical requirements. It's best situation is where your market cap just isn't able to support that sort of project equity funding requirements. Timing is usually after you've completed a PFS, it's kind of hard to get them in before you've done that PFS. And you're much better off doing a project level deal than a shared deal at that listed level, just because you can actually go off. You can get, I guess, more for your project if you do a project level deal rather than what the market values your project at. And then number 5, I guess this is a repeat of what works for a strategic, and with Boulder, it's our favorite. It's basically that can solve for a project's full funding requirement. Yeah. And that's it.
Anything in 25 is going to be different or not? Out of those, change any of those or not?
I think more transactions like Taiwan and Adair, where they come in earlier after the AFS would be good, just to help with some of that feasibility funding, because there's a real gap there. I mean, in the current market, if you're a gold project, you're pretty well supported. If you're a copper project, you can probably get some funding, but everything else seems to struggle a bit. How do you get it?
Yeah, no, to reiterate that point, that's probably why I suppose a lot of parties are coming in at the earlier stage, because right now I think equity markets aren't really supportive of juniors or the earlier stage developments. The risk appetite just doesn't seem to be there. It's hard going at the moment, but as everyone knows, this is probably the better opportunities to make money.
Right, that's a sickle book. That's like follow sell high.
If you're brave. Yeah. Thanks for attending. One thing I just want to highlight, we'll hopefully be distributing copies of the presentation, but if not, you can always I'll do a plug for our CFO Labs distribution list, which goes out to a whole heap of people in mostly in mining and resources, but other industries as well. So if anyone wants to sign up, we basically send out something every quarter. Next quarter, we're setting out a scoping study model for mining and related industries. So every quarter we try to do something different. So we'll actually distribute this presentation and so on at some point. So and feel free, our contact details is there. If you have any questions, just drop us a line, It's great. Yeah. Please join us with Drew. We'd love to have a chat to all of you. All right. Thanks, guys.